makers and market movers. This is The Pulse with Francine Lacqua.
Thursday the 13th, good morning. Welcome to The Pulse. I'm Guy Johnson in London. Francine is off today. Let's talk about what we've got coming up for you. The Fed signaling one cut this year, but Jay Powell keeps the door open to a possible second.
The most recent inflation readings have been more favorable than earlier in the year. However, we'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%.
That was, of course, the Fed chair. Wall Street shrugging off Powell's cautious outlook. The S&P hitting yet another record high. More of a focus on the CPI print than maybe the Powell story. European stocks dipping this morning. I'll get back to that in just a moment. Plus, we're live in Italy, the G7 summit beginning. Leaders are set to agree to tap frozen Russian assets. The idea there that they can use that money to fund aid to Ukraine. Let's talk about the markets. Look, today is in some ways just a kind of period of digestion. European equity markets gapped higher on the CPI print yesterday. We continued into the end of the day here in Europe on an upward trajectory, but that was pre-Powell, of course. US equity markets then rolled softer as we got the Powell comments and the maybe more hawkish dot plot, as a result of which we've just factored that extra little bit in this morning. As you can see, a little bit of red across the screen here in Europe. But in aggregate, I think you need to kind of factor in yesterday's session when you think about today's session. In terms of other asset classes, look, S&P futures are doing absolutely nothing. The 10-year is absolutely unchanged right now. Euro dollar is barely budging. Brent crude is down by 0.2%. Again, I think you want to look at yesterday's session for the market reaction to what we have learned from the Fed and the CPI rather than what we're getting today. Today is just a reaction, really, to yesterday. Everybody's kind of thinking about what they've learned. So let's think more about what we've learned. Let's get some interesting insights into what was delivered yesterday from the perfect person. Rich Clarida, Global Economic Advisor at Pimco, of course, former Federal Reserve Vice Chair, joins us now from Zurich. Rich, great to see you. Perfect person to talk to. What did you make of yesterday in aggregate?
Well, it was an interesting meeting. Obviously, no rate decision. I think the dots came in on the hawkish side with only one cut penciled in this year versus 3 in March. That's what I thought going into the meeting was more likely. I thought it would be a close call as it was. Obviously, in some ways, the Fed got trumped yesterday by the data. The CPI numbers were very Fed friendly. The core number was soft. Headline was around 0. And so it's interesting that even though you could argue the Fed on net was hawkish, it was on net a dovish day in markets given the CPI report.
Yeah. So are the dots old news, given the fact that we've got updated CPI, which is maybe a little bit more benign and positive?
Great question. You know, they could be stale. Now, the chair did acknowledge, as certainly was the case when I was there, that members of the committee do have a chance on the day of the meeting and yesterday after the CPI number came out to revise their dots if they choose to. He didn't want to go into whether or not folks actually had. To the extent they didn't, and certainly if we get more numbers like this, then they could be stale. But I more or less think that right now they are in data-dependent mode. I know it sounds trite, but I think they need to see a lot more good inflation data to have the confidence to cut.
How far through that journey do you think we are, though, Rich? We've talked about, and Chris Wallace talked about this, the need to see a series of data prints that are pointing in the right direction, that take us in the right direction. How big a tick in the box kind of down that road are we, given the CPI data that we got yesterday?
Well, I certainly think we're going to need, they are going to need more data than just the one more set of prints we'll get before the July meeting, which I believe is July 31st. And since there's no meeting in August, I think the soonest practical time to even think about a possible rate cut would be the September meeting. And then my own judgment is a lot would have to go right between then. You know, we'll get numbers for June and July and CPI for August. And so if you had 3 more numbers like what we got yesterday, then September could be possible. But I think barring that, we're probably looking at either November or December. And that's more or less, I think, where market pricing is right now.
I'm assuming December is probably more likely, given the politics that's going to be happening in November.
Yeah.
Would that be correct?
Yeah, indeed, the November meeting, if I look at the calendar correctly, Guy, the November meeting this year is the day after the election, which obviously could make sense if it's a close call to do that in December, yeah.
In terms of how we think of this in aggregate, Rich, the sort of the totality of the cuts, while the cuts come later, seems to be largely intact. We're going to get to the same place. We're just going to take longer to get there. Is that the right way of thinking about this?
Yeah, that was exactly, and indeed the chair more or less made that point yesterday in the press conference. It's fewer cuts this year than they thought in March, but they added an additional cut to 2025 and an additional cut to 2026. So they actually end up, now again, the further out you go in the projections, really the less informative they are. And you saw the chair yesterday in the press conference sort of remind folks of that point. But yes, if you just take the dots literally, they literally get to the same place they did in March, but just with more of it back loaded. And again, assuming that the inflation data does break their weight. Yeah, the other interesting thing about yesterday, when I think he was pressed by a reporter about cutting with inflation running at 2.6 or 2.7%. I think what they had was inflation running at 2.8 by the end of the year. The chair made some reference to that. I don't have the exact quote, but that would be a pretty good place to be. Now, obviously, the Fed is targeting 2% inflation, but it does reinforce this message we've had at Pimco for some time, not only for the Fed, but the ECB and the Bank of England and others, that they're really operating in a 2-point-something range on inflation. And once it gets there and they think it's falling, they can begin to cut and cut in tandem with declining inflation.
Is the focus on inflation, the Fed obviously, and you referenced a couple of other central banks there, the Fed has a dual mandate. Is the focus on inflation? Is the balance kind of 60-40 inflation versus what's happening with the labor market? How do you think the kind of the mix of inputs they're thinking about works right now?
That's a great question, because I actually think it's quite important in this cycle. I think it was clear back in 2022 and 3 that when inflation was too darn high, they were, in essence, a single mandate central bank. Even Chair Powell even acknowledged at Jackson Hole in 2022 that raising rates could cause some pain. We haven't seen that. It's been a very, very rapid and so far painless disinflation. And he got a question yesterday about whether or not they would cut rates preemptively because they were forecasting a softening economy and a rise in the unemployment rate. And he didn't commit to doing that. He said they want to try to avoid that. On the other hand, they also want to avoid a situation where they declare mission accomplished and then have to be hiking rates next year because inflation rebounds. And so my guess is that on net, they're going to really need to see some tangible evidence of economic slowing before they would actually cut, absent some better news on inflation.
Rich, the trade that everybody seems to have on is the steepener. Everybody's anticipating we get rate cuts. The fiscal position probably means the back end remains reasonably elevated, and that's the trade that everybody seems to want to have on. Yet we've seen very little movements in the spread 2s, 10s for really quite some time. Well, since the beginning of the year, really. When does that kick off? When does that, if that trade is the right trade, when do you think it starts to really materialize and work?
Really good point, because we obviously have an inverted curve, and we have now for nearly 2 years. So I think that's close to a record. At Pimco, we don't believe inverted curves are the new normal. The curve will re-steepen. So in that sense, it is the good trade to have on over the next several years. As in anything in financial markets, markets will try to get ahead of the inflection point. So sometimes, it's better to look at those opportunities not so much in spot space, but in forward space. So essentially, the way when our market's pricing them, the curve will steepen, and to try to look for opportunities there. But there's a lot of money on the sidelines right now, for example, in money market mutual funds. And my sense is that once we do get that first cut, or once it more or less gets priced in 100%, you will start to see a lot of moving in the direction of the steepening bias.
Rich, you're in Europe, you're in Zurich. We're watching quite a lot of political consternation here in Europe. And I'm just wondering how you're thinking about how investors, how portfolio managers should be thinking about political risk right now. It suddenly seems to have inserted itself into the debate in a way that it hasn't for a while. We're seeing it in France right now. We've seen it in some emerging markets. We're all looking so carefully at what is going to happen in November in the United States. How are you guys at Pimco? How are you thinking about kind of trying to navigate that? And what is the best advice you've got? And how are you thinking about what that process is going to look like?
Well, it was a focus of our recent secular forum. You know, we are certainly now moving into a multipolar world. More than 60% of the world GDP is in countries that are having or have had elections this year. We've seen surprises on both sides. You know, a surprise in India where Modi did not get the support expected. On the other hand, in Mexico, where Sheinbaum got more support than expected. Obviously, an early election in the UK, Macron now indicating elections for the parliament in France, the European Parliament. We could go on for several segments. The way we look at it at Pimco, guys, that there's always some element of geopolitical risk. But I think you'd have to argue now, given that we have a hot war in Europe and in the Middle East and the geopolitical risk, it just emphasizes that this is a volatile, uncertain world. And what we're doing is trying to put together for our clients robust portfolios that do well in all circumstances. It's a challenge, but I think there are opportunities there.
Rich, I couldn't have thought of a more perfect person to talk to digest and analyse
what
we got yesterday, CPI, the Fed. A genuine pleasure, sir. Thank you very much indeed. We always appreciate your time. Richard Clarida, Global Economic Advisor at Pimco and, of course, former Federal Reserve Vice Chair. Thank you very much indeed. Up next, we're going to take you to southern Italy. We're going to take you to Bari. The leaders of the G7 are meeting there. We are watching carefully to see a number of pieces of news evolve, particularly around Russia and the use of assets to support Ukraine. We'll do that in a moment. We'll take you live to Bari. This is Bloomberg. Thursday the 13th, let's take you to southern Italy. G7 leaders have got a full agenda. They've got a lot to talk about in southern Italy. The key focus, we think, is probably going to be around how we provide aid, how we finance aid for Ukraine, and whether or not we're going to be using $50 billion worth of profits generated from Russian assets that have been seized and frozen, and how those are then used to support Ukraine, and how sustainable that process is, I think, is a key question. Now, there is not a uniform view on this, so it's going to be interesting to see how ultimately this deal comes together. Let's get a sense of kind of where we're going. Let's go to Bari. Let's go to Ollie Crook. He is standing by for us. Ollie, how is this shaping up? What are we expecting to be delivered here?
Yeah, guys, so let's just set it back up and take a step back again. This has been the fundamental debate, what to do with these $300 billion of frozen Russian assets. The United States has advocated in the past seizing those actual assets and sending them directly to Ukraine to fund the war and get really the financial footing that Ukraine needs, not just for this year, but for the many, many potentially years to come. The Europeans have been much more hesitant about seizing the underlying assets, so what they've coalesced around is this agreement of basically issuing a check, cutting a check up front, and then basically repaying that over the years by the profits that is sitting in those central bank assets that are generated every year. Now, we understand the structure of that is changing a little bit, and we understand that there is now an early sort of political agreement that it will take the form of loans that will then be paid off, as those profits are generated through the years. But there's still a lot of technical details to work out, Guy, and we're still working on trying to figure out exactly what those are and where the sticking points are, because for the G7, this is their main deliverable. If they cannot walk away from this with something concrete, this will be really an indictment for the G7 at a time where there's perhaps not great sort of confidence in that group.
Is it about ultimately how Ukraine spends the money? I understand that the EU leaders are a little concerned that ultimately, if they were to guarantee loans, that money would ultimately then be used to support the US defense industry. Because that is largely where the money would be spent, and as a result of which Europe is carrying the risk and the US is taking the benefit. Does it ultimately come down to kind of how the money is used by Ukraine once those guarantees exist?
Yeah, Guy, that's a huge part of the conversation as well, and it sort of begins to usher into sort of all the details that they're needing to work through, right? So that is going to be part of it, is where the money is going to be spent. We really understand that they prefer it to be gone, obviously, to defense. Within that, is there a sticking point, but obviously also reconstruction going forward, and, you know, some of the general financing need that, you know, Ukraine is absolutely desperate for. But this is a very wide conversation. I mean, let's not forget, these assets are being held in Europe, right? So the Europeans potentially feel that they have a larger claim over them. They don't necessarily want to be more on the hook to have to repay if those assets ultimately thaw, and there's a $50 billion loan that still needs to be repaid. Guy, who's going to pay for that? That is going to be fundamental to working out the technicals of this deal.
Yeah. And what happens a few years down the road if the situation on the ground changes in Ukraine and in Russia? How are the recent EU elections complicating matters? How are events that are unfolding in France potentially complicating matters as well?
Yeah, Guy, I think this is a fundamental issue here, right? This is a sort of lame duck G7, or at least lame duck G6, right, where you have 6 leaders here. I mean, it's been crystallized by the EU elections in the form of Scholz and Macron. Macron's running a sort of full-out election campaign right now. He's sort of dealing with Marine Le Pen, who's sort of nipping at his heels. Olaf Scholz, who just landed just a few moments ago, by the way, you know, is being assailed by the AfD, who this week boycotted Zelensky at the sort of German parliament, basically calling him a begging president and really undermining Scholz and the government's position on Ukraine. So these are sort of how these issues begin to crystallize. But let's not forget, Guy, Rishi Sunak's not winning any popularity prizes, nor Justin Trudeau, nor Kishida in Japan. So this is a very sort of weakened G7 coming together that's really trying to pitch themselves as a sort of the strongest bloc within the global stage.
Yeah, it's interesting. You bring in China, you fold in China to that story as well. Ollie, great coverage. We're going to continue to keep you abreast of what is happening in Bari, in Italy. Any breaking news on some of the events that Ollie has been talking about, we will bring straight to you. So we'll be back with Ollie throughout the day. Coming up, what do we need to focus on? We need to talk as well about another element to the Chinese story, the EU hitting Chinese electric cars with tariffs. We're going to look at what it means for the bloc's trade relationship with China. What does it mean for its automakers? How is China going to respond, I think, is the next piece in this puzzle. We will discuss that next. We'll talk Tesla as well. This is Bloomberg. 22 minutes past the hour. We're waiting the start of US trading. Broadcom looks like it's going to have a very solid day. Stocks up really nicely pre-market on the back of the numbers delivered last night. Big Apple supplier here. The AI trade certainly working for it right now. So Broadcom's up by 14% pre-market. Another stock I want to mention that's up pre-market as well is Tesla. Looks like that stock is up by circa, let's call it 6.5% pre-market. Let's call it 7% actually, slightly improving on the numbers that I saw just a moment ago. Elon Musk out on the tape. Both Tesla shareholder resolutions passing by wide margins. Wide margins, quote. We are debating, of course, here what Elon's pay package is going to look like going forward. Significant scrutiny of what is happening here. Is he allowed to do that? Is he allowed to come out and say that they're going to pass by wide margins? Let's find out and talk more about what's happening in the car sector. Craig Trudell joins us now to discuss. I raise an eyebrow. Is that okay?
You know, we were talking in the break. It feels like it absolutely reinforces what the criticism of him and his board, has been. The fact that the Delaware judge who tossed his pay package said that his directors are conflicted, that shareholders aren't being sort of protected by this board, and in the course of fighting back against that, we've seen him openly sort of lobby for himself. Him sort of, seemingly get his own people within Tesla to push for his pay package. Putting aside whether you think it's right or wrong that the package was thrown out, a lot of the things that the judge, criticized him and the board for, he only seems to be reinforcing in the last few months.
Let's turn to what's happening with European car makers. Double-edged sword, these EV tariffs on Chinese goods coming into the country. The French seem okay with it. The Germans are clearly very nervous. When do we find out how China's going to respond?
I think the interesting thing for me here is this idea that, China is absolutely going to respond. I would be surprised if they don't do anything in response to the fact that, these tariffs are going up pretty substantially, at least in the case of SAIC, the maker of MG.
Yep.
But I do think that there's a concern about overdoing it here in the sense that the European market is the one market in the world that's buying a lot of EVs and spending, paying quite a bit for them. So, do these hurt these companies, the tariffs on these Chinese manufacturers? Absolutely. But they don't have necessarily a lot of other places to turn. So, do they want to escalate substantially? Maybe not. They may want to sort of be careful in how they respond here so as not to overdo things.
And it's interesting that some of these big Chinese companies are also building production.
They're also localizing, exactly. Yep.
To maybe kind of get around this whole narrative. Craig, thank you very much indeed, as ever. Perfect. Craig Trudell joining us on what's happening in the auto space. Up next, we're going to get the Labour Party manifesto out here in the UK. We'll find out more details about that next. Bronwyn Maddox is going to be joining us from Chatham House to discuss all of that, plus also foreign policy in the UK. Where's that going? This is Bloomberg.